Hi, everybody. This is Sunil Subramaniam, Managing Director of Sunil Mutual Fund. Just finished listening to the budget and on the television studios. And I thought I will give my quick first reactions to the budget as presented today by the Finance Minister. So, first of all, I'd like to start off by saying that this is, in effect, a mother of all budgets. Why do I say this? Because the budget typically is a document which is both a statement of the state of the country, kind of a situation, the financial situation, also lays out the plans for the future, and is eagerly awaited by not just by the middle class of the India, by the stock markets, by the debt markets, but more importantly by the FIIs and the rating agencies. So the picture it presents of India today and of the India of a year later is what is very critical. And I think given that in this year, there's a lot of uncertainty in the run up to the markets because from January onwards, we have had FIS selling in the markets are under pressure. Then the last few days, there has been one company specific, one group specific action which has had its impact on the markets. And the fact that this is the probably the last full budget that a government can present before the elections, and hence how far the government would become a populist kind of orientation to the budget was a key concern in the eyes of participants. So there was a lot of hesitancy and an air of expectancy around the budget. So from that perspective, when I say mother of all budgets, because it's a balancing act to say what we did with the money last year and what are we going to do with it this year in a way that nobody feels unhappy, right? And I think to that extent, the finance minister has done a very good job of keeping the rating agencies and FIs comfortable, to keep the middle class happy, and to keep the overall corporate sector, especially the manufacturing sector, reasonably happy. Let me now drill down to why I say these things. So, first of all, let's talk about it from a foreigner's perspective, right? So, what do the foreigners look at? They don't want India's risk to increase. And the risk is typically measured by the fiscal deficit, because as you're aware, most countries in the world spend more than they earn. So, to that extent, the deficit is actually what is done with the deficit is also important as how much the deficit was. So, the market was expecting last year's deficit to be around 6.4%, and it turned out to be as, which means whatever the government had projected last year, they lived up to that stream. Now, coming for the next year, right, in a time when the world is going through recession and most governments are going to be trying to pump prime their economies out of recessions, you're going to probably see fiscal deficits rise across the world. But given that our growth is in a kind of a shining light in a world full of recession, I think the finance minister has taken that nominal GDP growth, which our country should deliver, of a low double digit kind of 10 to 12%, and factored that in and brought the fiscal deficit expectations for the current year down to 5.9%. So this is a very good signal by the finance minister that we are going to remain disciplined. And she has further reiterated the government's commitment to reach a 4.5% fiscal deficit by 25-26. So all this is good stuff from a perspective that to a foreigner, right, that India is not going down and just go and spend your way out of trouble. The second aspect here is now that it's going to be a 5.9% fiscal deficit, that means that's the excess of expenditure or income. Where are you going to spend it? This is as important as how much are you going to spend. So though it's down to 5.9%, bear in mind that it's on a larger base. So roughly it looks like it'll be the same amount of expenditure last year, but the allocation to capital expenditure. You're currently at about 2.9% of GDP. The budget expects to take this to 3.3. And this has exceeded market expectations. The general number was hovering around a 3 to 3.1. So by allocating much more to capex than market expectation, the government, obviously the trickle down effect of capex is felt across multiple sectors, from banking to manufacturing to a whole bust. So that all those sectors now will see an incremental spend from the government trickling down to them in terms of the order books, and ultimately going down in terms of employment generation and incomes in the hands of those who get those jobs, right? So the quality of the expenditure again has been a very good trend, that the government's focus on capex remains, right? So that's on the way the foreigners will look at it, from a amount of fiscal deficit and also the quality of the expenditure. Now, when you come down to domestic, obviously this capital expenditure is beneficial for the manufacturing sector and the stock market listed companies. Obviously, market has taken positively to the fact of the capital expenditure trickling down to the market. But what the finance minister, in addition to the capex leading to an infra spend and a multiplier effect, has not forgotten the consumption aspect. So why do I say that? Because somewhere there is a give, right? I said that there is a glide path on the fiscal deficit downwards. If capex is increasing, then the leg room to actually give money in the hands of the consumers so they go and spend will be limited. But even with that restriction in mind, the finance minister has actually gone and across the board given tax concessions to the middle class and to the higher middle class. And that's again a very notable thing, because it's the higher end of the middle class which drives the higher consumption. By bringing down the marginal tax rate from about 42.5 to about 39, about 3.5% of cash at the higher tax bracket, you made sure that there is going to be money coming into the consumption space. So consumption is also likely to get a big boost. Apart from which, right, I think one of the important things that the market was looking for, and this is something perhaps not very widely stated, but it's an underlying trend of the market, is the fact that this government has by and large been a pro-reform, growth-oriented, capex-oriented government. Their coming back to power is probably something the market was looking for, a signal in how they use this. And that's where the temptation that this will be populist in order to ensure an election winning kind of a strategy for next year. But eschewing that, by doing this, I think the government has effectively also conveyed that they are, in a way, making the middle class happy, making the vote bank happy, coming back to power. But at the same time, the undertone of the budget, you see, is also very focused on employment generation. And that's where I think a confidence in the market that employment is one of those key things which are probably going to decide a significant factor in the next year's election. And if you see, there are multiple initiatives that lead to employment generation. First is an 80,000 crore allocation to the Awas Yojana, which going to the housing and the real estate sector, which are the largest employment users in the country. That's number one. Number two, I would say, is this big step on the tourism part, right? On their launching the public-private partnership in the tourism sector and allocating a significant amount of money towards that. Not only what they are doing is the multiplier will come because the private sector will now get a chance to participate in tourism. But the second aspect of the tourism is that tourism is also one of those high employment-oriented sectors. And plus, a lot of tourist spots in India are not in the urban metropolises. They are in the semi-urban and the rural areas. And as then you'll get people becoming tourist guides, and the relevant infrastructure development to make those tourist spots happy will lead to a lot more employment generation. So this also I view as a significant employment uptick the budget. The other thing is a lot of focus on the MSCME in terms of giving them the money for their startup money, giving them the lesser interest rate. The MSMEs are also probably the largest employers as a segment in the country. So I see a lot of subtle ways that employment is being supported and pushed up. And as these things start to play out, I think the confidence levels of government in terms of that will also improve. And then the other thing is that in terms of the tax breaks, one of the smart things the government has done is they have silently pushed the new taxation regime for all these tax breaks, thereby nudging the population to do away with their tax concession based assessments. So overall, this means that the pressure on, let's say, small savings which qualify for ATC and all of those comes down, and you will go into a cleaner tax regime, and where people just going and saying this is my tax rate, just paying tax, is I think a healthy move in the longer interest rate. The government doesn't need to come and announce concessions for housing, this, that, and all of that. So I think these were the main highlights of the budget from my perspective. The markets have reacted well to this. Yes, there will always be that specific rules around taxation and all that will affect certain sectors. So there will be a temporary negative reaction. But overall, if you look at it, a combination of infrastructure and consumption, a double engine boost will ultimately spill over and benefit almost every single company in the country by way of a greater job creation, greater disposable incomes. So the capital markets couldn't have asked for anything better. And finally, to round it off, there was a fear in the capital market on some tinkering to be done with the long-term capital gains tax, which could have had some negative inflation implications for foreign flows. By staying away from any of those kind of thing, I think the market has got comforted that the finance minister hasn't touched the capital market related taxation. So to sum it all, like I said, the mother of all budgets, because a brilliant balancing act between, on the one hand, fiscal prudence versus expenditure on capex, a balancing act between supporting infrastructure at the same time boosting consumption. So I think if you see that, in a difficult task, we have managed, I think, to give a positive shuttle to the growth story of the country, at the same time getting more money in the hands of the people of the country, and also giving a multiplier effect to the infrastructure driven growth story of India. All of these, mind you, are not so related to the world recession. So to the extent that we are now becoming more and more self-sustaining in terms of our growth path for the next year, I think we remain confident that the kind of growth projections for the next year that are implied in this are easily achievable. So the credibility of the budget as it stands today, I think, is quite high. And that's something that is reassuring to all of us as capital market participants. And with more disposable income, you can also expect more flows into the capital markets from the investor public, and hence the support to the market from fresh inflows is also something that will continue and keep making the market to reach new highs in the years to come. And finally, the FII flows, which have been going out since January, partly driven by these uncertainties, will hopefully, now that the clarity around the government's course of action for the next year is out in the open, will, I'm sure, lead to a gradual return of FII flows to a market, thereby giving a continued valuation support. So I do expect that the market will reach new highs during the course of this year. With that comment, let me end my perspective on the budget. Happy investing to all of you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.